Welcome, everyone. Today, my guest is Managing Editor James Kleimann to talk about the FHFA's new mandate to servicers, home equity finding its moment, and the new Rocket credit card. First, here's a word from our sponsor.
Hi, this is Diego Sanchez, COO of HW Media, and I'm joined today by Alex Ilazai, Chief Strategy Officer at United Wholesale Mortgage. Thanks for joining us today, Alex.
Hey, Diego. Thanks for having me. Good to be here.
So diving right in, we might be seeing the first glimmers of a rebound in the housing market. How is this playing out in the broker channel?
It's playing out really well, so we're excited about 2023. We see a lot of optimism in the market, just like we in 2022 and leading into Q4, and we're hitting the ground running really fast in 2023 here in Q1. We're excited about this whole year and what's upcoming. We've launched a lot of new products. We continue to see a lot of optimism in the broker channel overall. And obviously, when we're in a purchase market as we're in right now, that's where brokers really thrive in the more complex transactions with buyers and sellers and agents and a lot more going on. Just brokers are the best place for a consumer to get a loan. So we see a lot of them continue to grow and thrive.
Digging in a little more there, most forecasters are seeing rates in the 5s and the 6s for 2023 and 2024, which means we will be in a purchase market for the foreseeable future. Is this good for the broker channel?
Yeah, it's great for the broker channel. Like I just mentioned, just assume a rate's at 6%, right? We have temporary buy down products, just as an example, where you can buy down that product where the first year you're going to pay 4%, second year you're going to pay 5%, third year and beyond you'll pay the 6%. And by that time, hopefully we'll be in a position where we can refi that loan. So really there's just so much opportunity. To me, the way that we think about it, Diego, is like you're dating the rate, but you're marrying the house, right? So you want to go out there, if you see the house that you like, you see the property you like, you buy it, right? And you worry about getting that lower rate maybe in a back half of the year or even next year. But again, it's just going to be a short-term thing the way that we think about it. And still, relatively speaking, we're not talking about massive interest rates, right? I mean, the days of the 2s and the 3s that we were experiencing in 2021, that was somewhat of an anomaly. So we expect them to come down a little bit, and all the forecasters and economic indicators are pointing that fashion. But right now, I think we're in a good spot, and brokers are continuing to win. And you can see it in our broker share and everything that we're doing. We're just having an outstanding start to the year.
Yeah, I mean, the broker channel's had a great couple of years of growth. Do you expect that growth to continue in 23?
Yeah, we do. I mean, as you mentioned, in the third quarter, which was the latest quarter, actually fourth quarter, is about 22.5% or so of the market is broker now, which is, I think, at the highest since 2009. So we're continuing to see great trends in the overall growth of the channel. And we expect it to be 33% by 2025-26. Like that's what we're expecting to see the numbers come in at. And a lot of that is being driven by just literally hundreds of retail loan officers that are leaving retail and joining wholesale every single month. So those numbers are continuing to do great. And we're actually seeing it as another example, Diego, at UWM here. We have about 400 to 500 loan officers that come in every single week for Success Track, which is a great opportunity for them to learn, develop, network, and help grow the overall broker channel together. So you're seeing a couple thousand people a month that are coming in, and that was happening in all of last year, right? And all the years, several years before that when we started. But if you think about like the times that we're in, right? Everybody talks about a lot of the negativity, and that's what the usual focus of. But the reality is, people are excited about it. Brokers are excited about it. The market's growing. And at UWM, obviously being 100% wholesale, no other company in the mortgage space is better positioned than we are.
I love seeing the confidence and the leaning in that's happening at UWM. Alex, thanks so much for joining us today and sharing your insights.
Great. Thank you. It's good to spend time with you.
James, welcome back to the podcast.
Hey, good to be back.
Always great to have you on as we recap sort of what's been happening this week in the news in over all of our newsrooms. So let's start today with the FHFA and their decision to expand payment deferrals for borrowers facing hardships, which is, completely affects servicers. Talk about that story a second.
Yeah, this is actually a pretty big one. So the government-sponsored enterprises, Fannie Mae, Freddie Mac, they're going to allow borrowers facing financial hardships of any stripe, for the most part, to defer payments of up to 6 months for a mortgage. And the FHFA announced that on Wednesday. And so you probably remember that this used to be an option that was available to borrowers who fell behind on their mortgage payments because of the COVID pandemic. But now the GSEs are going to start to offer that to people who are experiencing other kinds of hardships, not necessarily, related to COVID. And so by doing this, we're essentially seeing kind of a lessons learned from the government. And so, we're going to have borrowers that are making the same monthly payment, but they're just moving past to amounts to the end of the loan. And we saw the FHE do this. We've seen, kind of a lot of changes to how, the government thinks about how to keep people in their homes after facing, financial challenges. And so this is a major step forward. And really, I think it is basically this is what we've taken away from COVID. And remember in the beginning, how scared people were and just, the mania around this idea that there are going to be mass foreclosures in the country in, say, like March, April 2020, remember? There was no liquidity in the mortgage market and everything was a disaster. And, a huge amount of the population couldn't work. And so this is one of the key things that the government did. And it was hugely effective. I mean, I believe the FHFA estimated that, Fannie and Freddie completed about 1 million COVID-19 payment deferrals during the pandemic. And it's not like, life stops once the pandemic is more or less addressed. Borrowers, especially as a recession approaches, are facing all kinds of different hardships. And so I think this is a really smart move, and the mortgage trade groups were really happy about it. And I know the servicers are pretty happy about it as well, because it provides, a sense of finality. It's so much easier to plan your strategy when you know exactly what the rules are and how things are going to wash. So in terms of the policy, the enhanced payment deferral has a voluntary adoption date of July 1st. So it gives the servicers a few months to kind of, get their bearings and plan out their responses. But the mandatory date by which they have to be compliant is October 1st. So, and you also might remember that basically the same thing happened in January with the FHA, which announced its servicers will have, the COVID-19 loss mitigation option available for any borrower who fell behind on mortgage payments, regardless of the hardship. It didn't have to be COVID related. So, this is a huge government push, and I think it's a really good one. And, we'll have to see how it develops over the next year or so. But I think there's a good chance that servicers aren't going to miss a beat, and they'll be able to implement this pretty quickly because, they've done it before.
I think those are great points. The fact that they did such a good job in COVID and, have been lauded even by the regulators who said, hey, you really stepped up and did this in a much tighter time frame under much more trying circumstances. I feel like, this is not going to be hard for them. And then also, one of the lessons from the great financial crisis is that a bunch of people in foreclosure has all these knock-on effects, but also it's really hard for the banks that owns those. That's not like the ideal outcome for anyone. I know that like consumers might feel like, oh, the banks want to take your house. The banks do not want to take your house.
No, it's a huge hassle. It's hugely expensive, and depending on which state you're in and the laws of that state, it can take many years before a foreclosure case winds its way through the courts and the bank actually takes possession of the house. And who knows what the condition is at that point. There might be squatters living in there. It might be full of all kinds of other problems, irrespective of the borrower's financial situation at that point, right? And so, I think it's in pretty much everybody's best interest if they can. There are always going to be some circumstances in which a borrower just cannot make the payment, regardless of what the payment is. It could be $500, it could be $1,000. There are, unfortunately, in America, all kinds of scenarios in which someone is infirm or just incapable of making that payment. We don't have the most robust social safety net here. And so that does happen. But I think by and large, as policymaking goes, this is a case where the government really did get it right. And this is a continuation of those policies. So it's a good thing to see. A lot of the affordable housing advocate groups have been cheering this move. And, it's not often that pretty much all of the housing industry and advocate sides are applauding the government for making a good decision. And this is one of those cases. So I think, it's good for all parties and especially the servicers. The bank does not want to go through this process and reselling it. They also have to get the value right, or they have to go through auction. It's a hugely laborious, really challenging, painful process for all parties. If you don't have to do it, why do it?
Well, and I think about, we have one of our staff members, Mike Simonson at Altos. He owns a house in Tahoe, and he's been posting on social like the pictures of his house in Tahoe with like 5 feet of snow on
Oh,
top
yeah.
of the roof that he clears off only just to get another 4 feet of snow on top of the roof. And this is one of the things about having a vacant house is the property preservation part of it is very tricky, and getting that right is really hard. But especially like in this kind of time frame when you think about spring, I'm in Texas, so we're in our tornado season, and nobody wants that. It's much better to keep people in their houses. I think the only thing that I was surprised at here is they didn't really list out what sort of hardships qualified.
Right. Yeah. So as I mentioned, the FHA had kind of a blanket rule, like any kind of hardship, whether it's COVID related, whether it's something else, qualifies. But I didn't see it in the release. But we'll have to follow up with the FHFA and see if they can break out. They said that there would be 11 hardships, but I didn't see a specific description. So we'll need to get more information from them on that.
To your point, though, like even in COVID, when there were people who worried, and, I don't think it's an unreasonable worry to be like, are people just going to take advantage of this and, really harm the system by taking advantage of it? But it's not an easy process to go through loss mitigation, even if that means your payments are different or whatever. So, we did not see that. We did not see just a whole bunch of fraudsters do that. We did see people who proactively were like, hey, I think I need this. And then they didn't end up needing it. But, it isn't like this is some really fun thing to do for people. And we're just going to see an avalanche of people who, for a whole lot of, stupid reasons, are looking for loss mitigation.
Yeah. And in some cases, I believe Wells Fargo got slapped for putting people into the loss mitigation kind of waterfall without their consent. And so there were definitely some instances in which, people, according to the government, really didn't quite get treated the way they should have. But I think by and large, the industry responded really well, and the borrowers, which is a little bit different from kind of the landlord tenant relationship that we often hear a lot about, especially on the multifamily side, where tenants would just not pay and go through the foreclosure process. I'm sorry, not foreclosure, the eviction process. Is a lot different than the foreclosure process, and that's been a lot more, I think, complicated. But for home ownership, the vast majority of people who are primary, owner occupants, wanted to make the payments, are not looking to get, any kind of, special deal or anything like that. They're in tough times. They don't have a lot of options, right? And if you can just tack on those payments at the end of the loan instead of, at the beginning, it gives them time to find a job. It gives them time to, find another source of money to make those payments and start getting back on their feet. And, I think that's been a big help, and it's just been good policy.
It is a good policy. Okay, well, let's talk now about home equity. So we know that home equity products right now are very, very popular. We had a story this week, home equity niche will benefit from a private label lift. Walk us through that story.
Yeah, so the demand for home equity loans, especially HELOCs, and sort of these shared equity investment products that are kind of getting more popular in recent years, they're now stronger than at any time since the global financial crisis about 15 years ago. And as Bill Conroy, our senior mortgage reporter, details, the securitization channels for these products are not quite catching up to the demand, but still, just the amount of tappable equity that homeowners at large have in their properties is absolutely massive. I know it's gone down a little bit because, home values have dropped a little bit since the heights of kind of 2021, 2022, but nationally, we're talking about more than $10 trillion in tappable equity. And so we're also facing a potential recession, right? And people do not want to necessarily sell and then take on a mortgage at 7%. Many are now opting to renovate the home or, create conditions at their house that make them more likely to stay for longer, get more value out of it, or, use it to pay down debt, credit cards, maybe you have student loans, maybe you have, medical debt, which, does happen in this country. And that's for a lot of people, the only asset that they really have. And almost everybody has seen an increase in their equity over the last few years, and some like considerably. I mean, if you bought a house in Austin, Texas in 2010, and you just have a kind of a standard 30-year mortgage on it, and you look at your equity now, having done nothing to it, I mean, hell, you've probably paid off that loan by now just in equity at this stage, right? Like, and there are so many markets like that in America. We've just seen an explosion in equity for the last 15 years, right? And in terms of being able to tap kind of that marketplace, when we talk about the mortgage banking industry, it is still very much a game of credit unions and traditional depository banks. Non-banks can't really hold loans on their balance sheets, right? So they need to find securitization channels and partners really to do it. And that's a tough business to crack. It does happen. We've seen some securitizations that have loans from Rocket and from Spring EQ and some others, but it is still very much, the business of kind of the traditional players that have been in there. But we also see new entrants, doing what we call these, shared equity investment products. And that's been really interesting. You get, let's say you're the homeowner, you put a little money in, you want to take some money out, and you can do so, and then you have to repay, the kind of the investment partner once you sell the house, right? Or over a specified period of time. Let's say it's 10 years. And so again, just another model where you can kind of tap some equity, and really, I don't know, maybe you put that in the stock market, maybe whatever, it doesn't matter. But, it's a product that has a lot of appeal right now because the rest of the mortgage market is still just not really a viable product for a lot of people right now, unless you really have to. And so we're seeing a lot more business here, and I think it's going to continue to be a pretty good, reliable product for those kind of aforementioned companies and types of companies over the next few years.
Really interesting. I know that within that story we quoted data from Adam, which said that HELOCs represented 20.7% of all the fourth quarter 2022 loans. So that's a lot, right? I mean, and to your point, it's because, we're in a pretty tough market where there's just not a lot of inventory either. So just from the standpoint of the volume of loans, the HELOCs are going to rise because there's just not that much inventory being sold back and forth. But I know that the banking crisis that we saw start with SVB and going on, I mean, that has an effect on the capital that's available here. What are we seeing?
Yeah. So, in terms of the traditional home equity loans, like you said, I believe it was 60 billion in HELOCs in the fourth quarter of 2022. And that's a huge number, the highest we've seen in quite some time. And what's interesting is we're also seeing from the non-banks, we're seeing HELOCs, we're seeing closed and second lien home equity mortgage products, which are kind of those IMBs that we didn't traditionally see. And so, that's one way for them to kind of build out, a viable equity product that they haven't really had access to in the past. And so that's been good. In terms of overall liquidity in the system, it's tough for a lot of these independent mortgage banks. And so they're starting to turn, to other options. They're trying to diversify their product mix a little bit. The big banks that have been in this space for a long time, they're fine. Nobody's worried about like PNC Bank going under. Nobody's worried about JP Morgan Chase having a problem. Bank of America has been big in this space for quite a few years as well. And credit unions, generally speaking, are pretty secure because of their model, right? And so that's not really the issue. The issue for the IMBs has just been, I mean, what was the statistic? Like the average one lost $2,800 per loan in the fourth quarter, which means, think about how many were below average and couldn't make ends meet. They're not able right now to just pivot to HELOC and just say, aha, like here's the money spigot and I can turn that on and suddenly I'm okay. I mean, you have to put a lot of work into this. You have to develop a team that can monetize, HELOCs and equity. It's a pretty complicated, fairly low margin business. Most IMBs don't do it because it's not very profitable, on a kind of per rate basis. And, I don't really see that dynamic changing all that much. So we'll have to see what happens over the next year, but it's a lot of other kinds of players that are getting into this space that are a little bit more kind of like tech investment, private equity focus. We're seeing some REITs in there. So, like Point, I don't know if you've heard of them. Redwood Trust is pretty active in the HELOC sector or shared equity contracts. And it's going to be a growing space just because there's so much money and people are going to figure out a way to tap it, right? Like nobody thought they could do a twist. I know they will disagree with my characterization of it, but nobody thought they could do a twist on the timeshare, but Silicon Valley figured out a way to do that and kind of make that profitable because there's still money to be made there, right? Like there's just a lot of money in equity. There's a lot of money in general that isn't moving all that much. And it's just a few kind of entrenched players. So if you think that you're, a REIT that can find the angle, that can kind of work on some of the shared equity splits, yeah, now's the time to get in there, right? So I think it's one of the more exciting spaces in mortgage and in the housing industry right now. And it's also, I think there is the potential for there to be a lot of could be a lot of conflicts between equity holders and some of these investment companies. Private equity traditionally is not a very sentimental, negotiation, heavy kind of business. So it's, there could be some conflicts down the road.
I think that's an excellent point. Some of the non-banks that are really into this space are, Rocket, Guaranteed Rate, United Wholesale Mortgage, Homebridge, Movement Mortgage, Loan Depot. So, we do have some of those big players, but, to your point, we also have some other people coming alongside them. And so, Figure, I think you
Yep.
talked about Spring EQ. Figure, they're a very interesting company, founded by Mike Cagney, who's, a veteran of this space.
Yeah, and they've done a lot of jumbos and they're very interested in HELOCs and they're kind of complementary products, right? Like, they're looking for very specific types of buyers and borrowers and that's a good niche for them. And so, despite, how much, origination volume there was in the fourth quarter, this is still kind of a niche ball game just because the barrier to entry is fairly high, and Figure has been kind of involved in this for a few years now, even before interest rates really skyrocketed over the last year. They were betting, quite a bit on HELOCs being a long-term business strategy. And so it's no surprise that they're going to stick with it. And I would expect this to be really not a place where the IMBs are going to gain a huge amount of market share, but where they want to at least, explore the potential of HELOCs and other kinds of equity models.
It's important in this market to look around. And that's really the next story I wanted to talk about was Rocket launching its first credit card to attract buyers and homeowners. And it's really part of their effort to bring consumers into their mortgage ecosystem in other ways. And I think this is really smart. I'm not aware of another company that does it like this. Are you?
Not in this space. There are kind of other spaces in which we start to see these sort of like points-based cards in housing. So there's a company, I don't remember the name of it exactly offhand, but they're working with a lot of the big multifamily developers like Related and those groups where they're basically saying like, hey, like you can basically pay your rent with this points card, and then you can use that, as part of kind of the larger ecosystem, and you can build up value through that. But this is the only one that I'm aware of in kind of the direct originations, mortgage origination space. And for Rocket, this is part of their larger strategy, and it's all about the funnel, right? Like they're obsessed with the funnel, and Rocket has been very clear that they're not thinking, quarter to quarter. They're not even thinking cycle to cycle. They're thinking, years down the road, and how do we address where we are as a marketplace competitor vulnerable? And to be frank, it's in purchase originations. They're excellent at refis. Their call center model was kind of the wonder of the mortgage world when they were, printing money during the refi boom in 2020 and 2021. And they were able to bank like, literally billions in cash. And so unfortunately, they've never, because of their model, been that close to the purchase action. So they have to figure out a way to get people into their ecosystem. And the way that they approach refis works because the call to action is pretty simple. Your rate is this on the TV commercial, I can get you this. And it's a simple proposition. Like, you look at the app, you go through your phone, you maybe call them up, and then suddenly you have a refi, and it's you don't have to go through the process of getting a mortgage broker or go into a bricks and mortar retail location and all that. But it's a totally different ballgame when you're trying to get purchase business. People still want to talk to a human and feel like there's someone guiding them through the process. And then that means that it comes through referral business, right? It comes through agents, or it comes through past, interactions with that client. Maybe they got a new home, maybe they're refining, and then going to sell in 2 years, and you check in, right? And so Rocket has absolutely nailed the refi game. When are we going to see another big refi boom? When are we going to see people? How many people have rates under 4%? How many people are going to be incentivized to refi in the next, I'm not a fortune teller, but I'd say very few are going to have a big incentive to refi, in the next 3 years. And so even though Rocket has a ton of money and is a bigger moat than almost everybody in the mortgage space, they're not invulnerable. AOL used to send me the discs, with the internet on them, and how long did that last, right? So they have to be smart, and this is a way of getting people into that funnel. And so in terms of the specifics of the card, let's say you get a credit card from Rocket, and in doing so, if you're looking to buy a home, you can earn 5% back using the Rocket. It's a Visa signature card for up to $8,000 that can be used toward closing costs and down payments. And homeowners who are making monthly payments to Rocket Mortgage could also use their card points, and they'll receive 2% of their card spending toward the UPB, the unpaid principal balance. So if you're a new card holder and you spent $3,000 in the first 90 days being approved, you'll earn a $200 stay-in credit. And then the firm is also going to waive the $95 annual fee for card holders who are also, clients because they have a mortgage with Rocket. So it's something, and I think the argument would be a lot of these prospective buyers would be using that credit card anyway to pay for home improvements, or maybe you need to buy a new oven, or maybe you need to do this or that or whatever. And so it's almost like, from their perspective, like found money, I still wonder about the idea of taking on additional debt after, buying a house, and all the conversations we have about the FHFA and the DTI components, right? And just, the position of debt for consumers in America, I think is always kind of a perilous one. How many people really have the savings? I don't know that it's globally a great thing to be encouraging people to take on more debt beyond a mortgage that they're already probably paying, quite a bit for, because rates are what they are. But definitely this is a long-term play, and Rocket has to get people in that funnel, and this is a way to do it.
I think it's so smart because it's integrated with Rocket Money. So that's their personal finance app. And
Truebill, formerly.
Yes, formerly Truebill. And to me, what they're doing here, there have been a lot of mortgage companies that are like, how do we stay in touch with the consumer outside of just this one-time transaction? How do we create that relationship? And they've really focused on the homeownership journey, which makes sense. It's like,
Sure.
so all these things, but this is kind of coming at it from a different point of view, and like, you're a consumer first, and one of the things you do is a house, but let's talk about all the other things. And I think that's really smart, because I'm not sure we've seen a huge uptick on those other programs where they've tried to connect with homeowners as homeowners, whereas this is like, goes straight to you, like the fact that Rocket Money, it's like that Truebill, so it identifies recurring expenses, especially it can cancel subscriptions. These are very of the moment things that you're identifying a need, right? We all have probably more subscriptions than we need or even realize we have, and they automatically renew it. It ticks me off so much when I see
Getting
that.
rid of
Like,
Netflix. Yeah.
Exactly. And so I feel like in other cases where people have like, let's expand the home ownership and our or homeowners, let's expand that relationship based on their home. This is really expanding the relationship based on everything else they do, and it is tied to the home. But I think it's really smart.
Yeah, the analysts who cover the company also were encouraged by the move, and they Rocket talked about this on their most recent earnings call. But at Keefe Bruyette Woods, KBW, for those who don't use the industry parlance, they think that this is also going to provide Rocket, with what they call interchange, which is swipe fees or interest income. So it's another revenue stream for them. It's probably not going to do much in the immediate term, but if we talk about the cost of acquiring a borrower, which is in the industry so bloody high, right? I mean, it takes thousands and thousands of dollars to get a borrower and to go through that whole process. How much cheaper, maybe Rocket could do it for a few $100, right? That could be big savings. Maybe then that means they can offer way lower rates, and that changes the whole game, because right now the problem is the cost to get a borrower is really high. And then of course there are the compliance and regulatory, fees that also kind of buttress that. But I mean, this could be a game changer in the aggregate. I don't think the credit card alone is going to solve Rocket's purchase problems, but it could absolutely open the door. And if you build on it and they get a little bit better at a few other things, suddenly, we maybe 2 years from now, we're talking about Rocket right being back where they used to be, right at number one, and dominating the purchase market too. It's very, very possible.
Also, I think about all of the information, the data they're gaining every time you swipe that credit card.
Yep,
I mean,
that's true.
That to me is just right there. Okay, so you're a homeowner with us, and now we know what you're spending money on, where you spend it, what percent you spend. I mean, of course, that may not be your only credit card, but I just think the insights they're getting, the data they're gaining, win-win all the way around.
And how to identify, other borrower profiles, right? And so I remember there was a story about, God, I think it was like somebody at Ford or one of the automakers, and they had done a ton of market research into people who bought a certain type of beef jerky because they almost always also bought a pickup truck. And so they would market, kind of toward the jerky eaters, and I think you could absolutely see a scenario like this, because we're getting a lot more sophisticated with the personalization. It's not just cookies on my computer, right? It's not just somebody, or not somebody, but an algorithm looking at my tabs, my 75 tabs right now. But it's really kind of piecing together profiles of people, and maybe the algorithm already knows that I'm looking to sell my house right now, and it's such a brave new world in terms of big data, and Rocket has as much data as anybody. They do their own servicing as well. They are a very well-oiled machine. They've invested a lot of money in sort of the technology and what they call a data lake. They if they can really monetize that for purchase, they could be in a great position for the long term.
Well, of course, this is the advantage that the big banks had with their mortgage customers all the way along, right? Like you have we know exactly what you're spending,
because loan there, you got your car loan,
and we know what you spend your money on. But for an IMB to get that sort of foothold in there, that's really different. So, well, James, we have run out of time once again. It always goes so fast when I'm talking to you. Thank you so much for getting on, and thanks for the great coverage.
Cool. Thanks, Sarah.